Thanks for clicking. All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of July, with the majority of the big banks predicting that the CPI would pop back up after the 2.8% inflation read last month. We got our answer at 8:30 this morning when inflation did indeed come in even hotter than expected at 3.3% in July. Bond yields popped up almost immediately following the announcement, as investors now think there's a greater chance that the Bank of Canada will be raising rates in September. Yeah, the hotter than expected inflation data could put more pressure on the bank to kick the inflation fight into high gear, as it appears as though the CPI is doing what the Bank of Canada warned about, remaining sticky.
No way, never happened.
Yet, that's not exactly how CIBC's Benjamin Tal sees it, who said just last week that the Bank of Canada has already overshot. So what I want to do today is go over July's inflation data, take a look at Benjamin Tal's interview and where he sees the Bank of Canada's thinking going forward, and then look at some growing signs that the bank may indeed raise interest rates in September. The Canadian Real Estate Association just released its data for the month of July, showing a real estate market that is continuing to slow. We will have an update out on that data on this channel. Click like and subscribe if you want to get that update. But for now, let's get into this inflation data. Onto the data. As mentioned, Canada's inflation rate for the month of July came in at 3.3%. The acceleration of the CPI is largely being attributed to base effects, in that higher gas prices from this point in time last year are no longer pulling down our inflation data. And given that so many of the usual suspects were calling for rate cuts last month when the CPI came in at 2.8%, then logically the reacceleration of the CPI due to the dissipation of base year effects, those same suspects should be calling for rate hikes, right?
Well, no, but
regardless, if we exclude mortgage interest costs from the CPI calculation, if borrowing hundreds of thousands of dollars was free, then the CPI came in at 2.4%, accelerating from last month's 2%. With that said, we also received some good news, relatively, as food price increases came in at 7.8%, while still exceptionally and historically high, still much better than the double-digit increases to which we've become accustomed.
we should celebrate.
Further, core measures of inflation, which strip out more volatile items like food and gas, and the measures which the Bank of Canada looks to when deciding whether or not to raise or lower interest rates, also receded, though marginally, with CPI trim falling from 3.7 to 3.6, CPI median remaining the same, and CPI common falling from 5.1 to 4.8. So, in summary, we have the CPI back up over that 3% mark, and although many had anticipated that inflation would pop back up with the dissipation of base year effects, most economists didn't expect it to go up this much. So, will the hotter than expected inflation data lead the Bank of Canada to raise rates again in September? CIBC's Benjamin Tal says that the bank has already overshot on its interest rate hikes.
Whatever we see now since the beginning of June and maybe even to September is pure overshooting by design.
Indeed, the bank has already raised interest rates by 50 basis points since June. And Tal says this is because the bank is biased in favor of rate hikes, as interest rate hikes leave them more options for the future.
Know that if they overshoot, they can fix it by cutting interest rates. If they undershoot, then inflation expectations go up, you don't know what to do with it.
And yeah, we've talked about that before on this channel. If the bank raises rates too high and does indeed cause a deep recession, they have tools for that. They can lower interest rates. They can stir up the money printer and restart quantitative easing.
Yeah.
However, if they let inflation get out of control and inflation expectations set in, then they could have a real problem on their hands and have to raise interest rates even higher in the long run. And as such, Tal says that the bank is jawboning when it says that inflation will remain high until 2025.
By doing so, you're actually not losing anything because you keep telling the market, listen, inflation will go down. Therefore, you control inflation expectations. But at the same time, you're not required to respond to any hawkish economic news.
So the idea is that as the bank stresses publicly that inflation is going to remain high until 2025, consumers hear that message and think that rates are going to be high until 2025 and don't spend, which gives the bank the effects of interest rate hikes without actually having to raise them. And I think Tal has a good point when he talks about the bank wanting to manage inflationary expectations, making Canadians think that rate hikes are going to be on the table for much, much longer, in the hope that Canadians won't re-accelerate their spending. And there's already growing evidence that Canadians are anticipating that rate cuts are going to be coming sooner rather than later, with variable rate inquiries rising as homebuyers bet that interest rates have peaked. And I think the Bank of Canada is well aware of these changing expectations, especially heading into the fall real estate market, which is typically fairly busy, given the extent to which we saw the real estate market reinflate following the Bank of Canada's previous pause. We could see the bank try to prevent a similar reinflation during the fall market, and indeed raise rates in September. A 25 basis point rate hike might not do a whole lot in terms of pulling money out of the economy in terms of decreasing purchasing power, but it could very well go a long way to managing expectations on the part of Canadians. Add to the managing of the real estate market. Last week we had data come out showing that wage increases had accelerated up to 5%, higher than the rate of inflation. Further, as we're all well aware, gas prices are up. And while that doesn't mean a whole lot for now in terms of the inflation data, typically higher energy prices will work their way into everything else, into higher services, into higher goods, into higher food prices eventually. And the bank could very well want to get ahead of that. So we have managing the real estate market, we have wages accelerating higher than the inflation rate, and we have higher gas prices as well. And that's not even to mention U.S. retail sales that came out this morning, much hotter than expected. If the U.S. economy isn't slowing down as fast as the Fed would have hoped, then that will put more pressure on the Fed to increase rates, which will put more pressure on the Bank of Canada. So, all in all, inflation, as expected, or should have been, re-accelerated in July, due in large part to the dissipation of base year effects. Last month we were sitting at 2.8%, this month we're sitting at 3.3%, and the acceleration combined with wanting to tamp down the real estate market, wage increases that the Bank of Canada has consistently warned about, increased energy costs, and a resilient U.S. economy could in fact give the Bank of Canada the ammo it needs to kick the inflation fight into high gear, to raise rates again in September. With that said, we will have updates out on the Bank of Canada's announcement on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, thanks so much for watching.